Welcome to the 2019 Midyear Outlook. My name is Joe Graham. I'm an investment strategist here at Lord Abbett. Today I'm surrounded by some of our leading investment professionals. We'll be talking about markets, what's happened over the last few quarters, and where the opportunities are today. So now I'll turn it over to these individuals to introduce themselves.
Hi, I'm Leah Traub, partner and portfolio manager in taxable fixed income.
Hi, this is Q-Jin Ya, partner and portfolio manager of taxable fixed income.
I'm Dan Sullender, partner and director of the tax-free fixed income group.
This is Tom O'Halloran. I'm a partner of Lord Abbett and a portfolio manager of the growth strategies.
I'm Giulio Martini, partner and director of strategic asset allocation.
Are there still opportunities in the municipal market, Dan?
From my perspective, looking at from municipal bonds, I'm more concerned about the bottom line of this rather than all the details a lot of other people focus on. Because in the municipal bond market, about 2/3 of the investors are retail individual investors, and they invest based on sentiment. They don't have inflation expectations. They don't look at the growth numbers, say 3.2 versus 2.5. Right. They're more sentiment focused. And from that perspective, there's a lot of opportunity right now because the economy is doing well, people are working, people are making money, tax receipts are coming in very well. So from that perspective, individuals are very comfortable. You compare where we are now in the beginning of 2019 to where we were in 2018. And the whole impact for me of the Fed, whether the Fed raises a quarter, lowers a quarter, what's more important is that the move is not going to be very big. That makes investors comfortable that rates aren't going to move much. So since they're comfortable with the rate environment, last year they weren't, this year they are. So from that perspective, what that carries over in the municipal bond market is that we have very, very strong demand because people are comfortable where the rates are going to stay, not to be too volatile. We have an environment where we just came through a tax bill from 2017 that's dramatically changed people's sense of wealth, where in any state that's a high tax state, people got through tax season, found out they didn't get a tax cut in the high tax states, they're paying a lot of money, and that's made them want to search for municipal bond tax exemption. So we have very strong demand based on the tax bill, based on the comfortable rate environment. And then on the supply side, the tax bill took away about a quarter of our supply. So our supply is down. So we have high demand, low supply. So that's leading our market to outperform some other markets. So the ratios are getting lower, but in this environment, people are comfortable. We're seeing in the first 4 months of 2019, about $30 billion has flowed into municipal bond funds. That's the record. They've been counting since 1992. It's never been close to that. So we have an environment where people are, all the important details everyone's talking about are very important. The underlying sentiment to individuals is things are calm, rates are calm, they're comfortable with where they are. Their taxes are going up. They're going to have to pay taxes. Supply is down, and they just keep trying to find ways to cut their taxes bill where they can.
How about credit? Are investors are you getting paid for taking more credit risk within munis?
We are. Lower quality has been outperforming. We've been going through several years now, just some of the taxable side in certain ways where everyone keeps saying spreads are too tight. It's not a good time to take credit risk yet. Credit risk keeps outperforming every year. And we're in an environment where it keeps doing well. And there's still a lot of value in that part of the market. And the biggest flows of investor money are going into our high yield part of our market. That's where we're all seeing the strongest flows. So there's good value, credit's holding up well. And certain parts of the market, obviously with all the strong performers, certain parts are overvalued, but there are a lot of different parts of the market and things still look good.
So retail investors are feeling very confident. Another place you might see that is in the IPO market, which has been pretty hot lately. Do you think the market's getting ahead of itself there, or can it handle the recent IPO supply?
I think it can more than handle the supply. These are great companies coming out. I've been very busy with debutante balls this month, and the reason is that we had a market correction in the fourth quarter. So no companies came public, and then the government shutdown lingered into the first quarter. So it was really 6 months where the IPO window was shut, and now these companies are coming out, having been bottled up for a long time. But they're great companies. They're very disruptive. One company is disrupting video conferencing. Another company is taking what Amazon has done here to Africa. There are great software companies, social network companies. So these companies are growing 50 to 100% a year, and they're very promising. And as a growth investor, I'm looking for these opportunities in the revolution of the brain, which is what I call the tech revolution. And when we look at things like search and hosted software and social networks and e-commerce, these are extraordinarily powerful trends. And they provide some type of gale winds to the economy. Joseph Schumpeter, the economist, talked about the constant of capitalism being creative destruction as the perennial gale of capitalism. And it's happening in a much more powerful way today than it ever did. And I think most people underappreciate what that is doing for growth investing and how much it's hurting value. And I'll use the example of Polaroid. Polaroid had 110,000 employees in 1998, and it had a $24 billion market cap. In 2012, it had 11,000 employees, and it was bankrupt. The next year, the company that slayed it got sold for $1 billion, and it had 13 employees, Instagram. So the pace of technological change has accelerated, because what's really going on is the tech revolution continues to grow in processing power at an exponential rate. And our mind doesn't comprehend what that means. If you take 30 linear steps, you're 30 times higher. If you take 30 exponential steps, you're 1 billion times higher. So this tremendous processing power is proceeding, and we're doing a very good job of converting it to real-world opportunities. And one of the big areas is mobility. You don't have to go to the mall. You don't have to take your car there. It's safer to do it from your house. You're probably going to get everything cheaper. So mobility has been one of the big areas of the tech revolution, and we have a couple of new companies that are doing their debutante balls that are transforming the way we're transported. And not just the way we're transported, but the way we're going to get our food, the way autonomous vehicles are going to move around. So this is all really good stuff. Now, I don't know whether these IPOs that have just doubled or tripled can sustain their prices. Probably that's debatable, but they're very fine companies, and it's not a case where there's too much froth in the equity markets. And I'm very bullish on the equity market. I think we're going to break out to new highs soon. And one of the main reasons is what we've been talking about, that our economy continues to expand and inflation is very much under control.
You know, I read a lot about corporate debt increasing and serviceability of that corporate debt. Especially in the leveraged loan area, seems to be something that people talk about where standards have weakened somewhat over the last few years. Is that an area that concerns anybody here?
There are numerous numbers that we could put out there, but it really was, when it comes to a structured product, the most important thing is that there is credit enhancement and then someone owns the equity. In a CLO, the BB rated tranche has 5% of credit enhancement. During the financial crisis, cumulative losses did not exceed 2.5%. So BBs were money good, right? It was the equity tranche, or the equity holder, that really lost out. So again, the CLO market is underwritten in such a way and structured in such a way that it doesn't pose the risk that the subprime non-agency RMBS market.
There are two other points that I think are worth making, is that in many ways, CLOs are substitutes for high yield issuance. Issuers who would have normally issued high yield securities are instead issuing CLOs.
Or leveraged loans.
Leveraged loans that then get packaged into CLOs, yeah. So in a sense, when you put those two markets together, it's actually investors are safer because the covenants in leveraged loans at least exist, whereas in high yield loans, they're absent, right? So to the extent that it's a substitution, it's actually giving investors more credit protection than they would have in high yield. The second thing is that leveraged loans are typically not held as much by depository institutions as they used to be. And the way that the financial crisis developed was because banks held a lot of risky securities that then created huge losses and stopped intermediation in the financial system as banks started to recover. Leveraged loans and CLOs are held much more widely by institutional investors, by mutual fund investors, and by investors overseas rather than by U.S. depository institutions. So even if a problem develops, the potential for that problem to then spiral out of the financial system into the economy as a whole is much less with those instruments than it was with, some of the securities that really took the system down in the financial crisis. So Hugh's right, it's too small, but also the way it's owned and the holistic financial system perspective just suggests that it's not a systemic threat.
But I guess my question on that is, how does it affect corporate profits if you can't borrow in the loan market, you have to go borrow in the high yield market, longer term bonds that have higher yields? There's more speculative companies, something of higher borrowing costs. Does that hit the stock market? Because the companies in that part of the market, the more smaller cap, have to have higher borrowing costs.
Well, we'll see it in the stock prices if that's happening. Right now, we're not seeing it, but it's out there as a risk for sure.
As we're sitting here, the U.S. stock market has gone to a new high and just exceeded, the September level. But if we look at valuation has not returned to those high levels. So at the peak in late September, U.S. stocks were selling at 18.5 times forward earnings. Right now, they're selling at 17 times. Having come back from about 14.5. So we've made new highs in prices. We have not made new highs in valuation. And the same with high yield spreads. High yield spreads are 350 to 360. We touched 304 at the tightest before. And so more or less across the board, even though there's been a rally in markets and investors have gotten the money back that they lost in the fourth quarter of last year, valuations have not recovered to those, peak levels that they were at the end of the third quarter.
Let's end on that optimistic note. Thank you all for your time, and thank you all for joining.